It's another sad day in retail history. Luxury merchandiser Saks Global is filing for bankruptcy. Our guest says brick and mortar retail has been under pressure for years, and department stores are going to have to radically evolve to keep up. Let's get more from Jack Manley, global market strategist at JP Morgan Asset Management. Great to see you, Jack. I guess the thing with department stores is you need to have a certain amount of magic. You can't always be selling at a discount to make money.
That's exactly right, Andy. I mean, when I think about what's going on right now in the retail world, as you said, brick and mortar's been under a lot of pressure for quite some time, and its demise, let's call it what it is, was really accelerated by COVID, right? A lot of people staying at home, ordering online, a surge in e-commerce. People just don't really go to the store anymore to buy kind of everyday goods. You're not doing your back to school shopping at the mall any longer. That doesn't mean that retail's dead, though. It's just different. And when I think about what's working right now in the world of retail, even brick and mortar retail, it's going to be much more experiential. And I think that highlights exactly how you describe that, right? Adding something to the mix. What's working in retail? I mean, it's where your nail salon is or your fitness studio is. It's where the movie theater is, the arcade, the brewery. That pocket of retail is actually done quite nicely. The other pocket of retail that's done quite well for quite some time has been the luxury side of things. Because, if you're going to be spending a lot of money on something, whatever it happens to be, a handbag, a watch, a suit, a car, generally speaking, you want to touch the thing, right? You want to see it in person. You want to be there and experience that good before you lay your cold, hard money down on the table and purchase the thing. But when you think about luxury retail, a lot of that is smaller. It's more intimate. It's more boutique-y. It's not a full city block 10 stories tall. And so we're seeing a lot of challenges with department stores. We've been seeing them in the U.S. and in Canada over the past several years. And I think, unfortunately, we're probably not going to see an end to this decline anytime soon.
How are you treating energy stocks, in particular oil, right now, with concerns that America may get involved in some kind of pressure, even attacks on Iran?
Look, I think there are, frankly, too many moving parts to have a very clear view on what's going on with Iran. It is important to remember that oil is a true global market. So more supply in one place met with less supply in another place may just end up netting itself out over the course of several weeks or several months. When we think about Iran in particular, they are, of course, a large producer of energy products. Iran is undoubtedly a petro state. But while they are a large producer of energy products, they sell to a very small number of countries in the grand scheme of things, right? The United States not buying a whole lot of Iranian oil, the Europeans not buying a whole lot, the Canadians not buying a whole lot. So Iran's impact directly on global energy markets is limited. That said, because global energy markets are exactly that, right? They are global. Political pressure in Iran may end up causing a reduction in production. And if that ends up being the case, we might see, all else held equal, and that's an important contingency, all else held equal, a little bit of upward pressure on energy prices. But Iran has broader influence on global energy markets because they also control the Strait of Hormuz, which is a major transit point for the bulk of the oil that is produced in the Gulf region. And if they were to, say, shut down access to the Strait of Hormuz in response to foreign intervention in the protests that are happening, that would have a much larger impact on global energy markets, would end up putting considerably more upward pressure on those prices. But if we take this out even further, and this is why things get really complicated, right? If we do end up ultimately seeing regime change in Iran, and maybe it looks a little bit something like what happened in Venezuela recently, maybe it happens in a different way, all of a sudden all this energy that is produced in Iran starts to become accessible at a global level. Sanctions are dropped and now prices are falling, right? And that brings me right back to my initial comment, which is too many moving parts to have a very clear view. Stay tuned, I guess I'd say. Pay attention to it, but don't make any big bets right now based off of the headlines.
What trend broadly do you see for stocks in 2026? And I know there's multiple factors there. It's a very broad question.
It's a good question, though. And look, it's the start of the year, so it's a great time to be having that conversation. I think a lot of the themes of 2025 are going to flow through into 2026 and carry us into another good year of equity market performance. But I do think those themes are going to be a bit dampened, a bit diminished relative to what we saw last year. Right, 2025 was a year where the rest of the world outside of the U.S. really seemed to wake up. Right, the TSX outperformed the S&P by its widest margin since 2009. In fact, most global markets outperformed the U.S., with the real notable exception of India over the course of last year. I think there have been some really exciting structural changes that have happened in foreign markets, particularly in Europe and in Japan. That means that their longer-term earnings potential has permanently been rebased higher. I would not be surprised if we saw another good year of ex-U.S. equity performance. What I would be surprised, though, is to see another year of where companies outside of the U.S. or indices outside of the U.S. beat U.S. equity performance. I still fundamentally believe in U.S. equity exceptionalism. I still have an overweight to U.S. stocks within any sort of portfolio I may be looking at. I just think that overweight is a little bit smaller than it had been, let's say, 2, 3, 5, 10 years ago, when ex-U.S. markets were really dogs and not performing particularly well at all.
The Mag 7 it was a huge driver of the markets in early 2025, and that tailed off towards the end of the year. How are you playing the Mag 7 in general right now?
Now, that's an interesting question, too, because when we think about the Magnificent Seven, they are undoubtedly treated as a monolith, and for good reason. Over 60% of the returns in 2023, over 50% of the returns in 2024, almost 50% of the returns in 2025. But a statistic that I think would surprise a lot of people, only 2 names out of those Magnificent Seven companies actually outperformed the S&P 500. Isn't that interesting? And what it means, right, is I would not be surprised, Andy, if, let's say springtime, summertime of this year, the Mag 7 as a phrase, as a concept, has kind of gone the way of FANG. And we have a new way of describing this kind of broader, big picture, macro AI trend that is very clearly sweeping global equity markets. So what will the Mag 7 do this year? It's hard to say. My guess is that the trend continues. It contributes less and less to the total overall equity performance you see in the United States. But that doesn't mean that the AI trade is over. It's just broadening out. It's other names directly involved in that space. It's other names maybe indirectly involved in that space. A lot more attention being paid to the infrastructure behind artificial intelligence. Perhaps this could be a good year for utilities, materials, industrials, even certain pockets of real estate on the industrial side of things. This AI story is not going anywhere. It's just looking different than it had in the past few years.
Great to have you join us. Thank you very much, Jack Manley,
Thanks for having me.
Global market strategist at JP Morgan Asset Management.